Welcome back to the Global Ledger. I'm Justin. Over the last few episodes, we've been building out the modern architecture of monetary control. Interest on reserves, the federal funds rate, balance sheets, and standing facilities. Today, we're going to talk about the one tool that's always there that almost no one wants to admit they use. Okay, that is the discount window. It's one of the oldest tools in central banking. It's explicitly designed to provide liquidity, and yet banks go to extraordinary lengths to avoid it. So today's question is simple. If the discount window exists to stabilize the system, why is it so stigmatized? And why during stress does everyone end up using it anyways? By the end of this episode, you'll understand why. Let's get into it. At its core, the discount window is straightforward. It is collateralized lending from the central bank to banks. Okay? If a bank has eligible collateral, treasuries, agency securities, high-quality loans, it can borrow reserves directly from the Federal Reserve for a specified term at a specified rate. That isn't a bailout. It's not any kind of emergency money creation. It's secured liquidity. Okay, historically, this was the core function of central banking, to lend freely against good collateral at a penalty rate. Okay, that structure still exists today. The Federal Reserve explicitly describes the discount window as a backup source of liquidity designed to support financial stability by providing funding when markets are impaired. In other words, the discount window exists so that temporary liquidity problems do not become solvency problems. But notice the phrase backup source. That's where the stigma begins. Okay? So let's talk mechanics about this, okay, and why the discount window is a ceiling. In the modern system, we've already established that interest on reserve balances, IORB, sets the floor, okay? Again, going back to that really quick, this is because the Fed has an offer rate to banks that says, hey, here is a rate that is guaranteed. So that sets a floor for banks to where they're like, okay, well, why would I lend to anybody else for less than what the Fed can get me? Okay, that's the whole thinking behind it. Okay, so that's interest on reserve, and that's the floor for banks. And then we have standing repo and ONRRP, and that they reinforce that floor, which we'll talk about those two in depth soon. But the discount window does the opposite. It sets a ceiling, okay? And why? Because no rational bank will borrow overnight funds in the market at a rate higher than what the central bank charges at the window, okay? So the discount window rate is deliberately set above market rates in normal times. That's, not a bug or anything. It's really a design of the system. So it ensures banks use private markets first and the central bank second. So mechanically, IORB anchors rates from below the discount window, caps them from above, right? So IORB anchors rates from below. The discount window caps them from above. Market rates trade inside that corridor. This is not theory, it's operational reality, okay? But that still doesn't explain why banks hate using it. So the real reason banks hate the discount window, okay? The problem is not the cost. The problem is signaling, okay? When a bank borrows from the discount window, it sends an implicit message. We could not obtain funding anywhere else, okay? And in a leveraged, confidence-based system, that signal really matters. So historically, discount window usage was visible. Okay, counterparties could infer stress. Okay, markets would react. Even today, despite confidentiality protections, banks worry about regulatory perception, market interpretation, rating agencies, right? Counterparty behavior. In other words, the discount window creates reputational risk, not financial risk. That stigma became deeply embedded after past crises. where banks that accessed the window were later revealed to be under severe stress. So banks learned a lesson, and that was rationally, okay? Avoid the window unless you absolutely must, which leads us to the paradox. Why banks use it anyway? Because when liquidity evaporates, stigma does not pay bills. During systemic stress, private funding markets seize up. Interbank lending dries up. Repo haircuts rise. Collateral becomes trapped. Counterparty risk explodes. At that point, the choice isn't, do we look weak? It's, do we survive the day? And that's exactly when the discount window fulfills its purpose. It becomes the ultimate backstop, not because it's cheap, but because it's certain. This is why in every major crisis, discount window usage spikes, often quietly, often in parallel with new facilities designed specifically to reduce stigma. Which brings us to an important valuation. How the system adapted to stigma. Okay, policymakers didn't ignore the stigma. They engineered kind of around it. Instead of forcing banks to use the discount window directly, the system introduced broad-based facilities, anonymous operations, and standing mechanisms available to many counterparties. The idea was simple. If everyone can access liquidity, no one looks weak. But notice what didn't change. The discount window never went away. It remained the final backstop, the tool of last resort, if you will, or even the anchor at the top of the rate corridor. And critically, its mere existence stabilizes markets, even when it's not used. That's the part I think most people miss. The discount window almost as a psychological infrastructure. Think of the discount window less as a loan facility and more as insurance, if you will. Insurance you hope you never file a claim on. Insurance that calms behavior simply by existing. Banks lend more confidently when they know liquidity is always available or collateral can always be mobilized. Temporary shocks won't cascade uncontrollably, okay? This is good, okay? When banks know this is good. That confidence reduces panic before it starts, which is why the discount window is not a relic. It's really foundational, okay? And in today's architecture, alongside IORB, standing repo, and balance sheet tools, it really completes the system. So I want to thank you for listening to episode 55 of the Global Ledger. If you've been following the series, you can now see the full corridor. We talked about the floor, which was the interest on reserve balances, okay? IORB. We talked about the middle. This was market pricing, okay, right? And then the ceiling, the discount window, okay? This is not about stimulus. This is not about printing money. This is about rate control, liquidity containment, and systemic stability. So really, really important to kind of keep these in the back of your mind as we navigate through the series, okay? Because we will get really in depth on rates and open up real market data as well. So in the next episode, we're gonna talk about something called forward guidance. I think you guys have heard about this, and expectations as a policy tool. Once again, I'm Justin, and thanks for being here.